So with all that aside, moving right along, we are at our first panel. Just some logistics. The clock will be at 35 minutes, so as soon as you want to ask questions for the moderator, you start at 30 minutes. And moderating our first panel is Alistair Goldfisher. He is with Thomson Reuters, the editor of their venture publication. And I also understand he's an Oakland A's fan. Any Oakland A's fans here? Okay, I think they're playing now. It's a big game. So, Alistair, why don't you take it away?
Oh, we're going to start?
Yeah.
We have to get our panel up there.
You can introduce the panel.
Oh, okay. Watch your step. Well, thank you very much, Bambi. And just for the record, my sons think that I'm at a spa day too. They don't understand what I'm doing for a living. Yes, thank you. Just so everyone knows. Thank you. Well, thank you very much. And yes, I am Alistair. I'm editor of Venture Capital Journal, and I need some people up here. So Renata, Cindy, Paul, Dave. And we'll get started in just a moment. And I'm sure that I'm going to be the first one to fall off the stage today. Well, thank you very much. We're here to talk about early stage investing, and we got a great panel of 4 investors here. Make sure we're all set up. But why don't we have each one of them introduce themselves. Renata, kick us off.
Yeah, hi, good afternoon, everyone. I'm Renata Quintini, a partner with Felices Ventures. We're a firm based out of the Silicon Valley. We're formed in 2006. And today we have about $110 million under management. And for us, our mission is pretty straightforward. We view our role to back the iconic companies of today and tomorrow. And in practical terms, it means we focus on sectors that we think are high growth or really disruptive technologies. And we try to find the best companies to partner with, irrespective of stage or geography. And I'm particularly proud to say that 2 of the companies that are going to be talking after our panel today, e-commerce and All12 Apps, are Felices companies. We have 20 female founders in our portfolio. We don't have a particular mission to back female founders, but it's just very gratifying to see the increasing role that women have been playing in the ecosystem, and it's just a pleasure to back them.
Hi, my name is Dave Mcclure, founding partner of 500 Startups. We have about 80 million under management. I think some of that we haven't spent yet. Exactly right. Oh, shit, we're all out. We've done a small number of investments in the last 3 years, close to maybe 600. Female portfolio is probably about 15% women CEO, probably 25 to 30% women co-founder. I think that probably puts us #1 in terms of number of women funded, and probably easily in the top 10% for percentage of women funded. I know your topics is on married founders, and we've actually done probably over 20 married couples and a few more that are probably not married but working together. Have had some of our biggest exits from that. Wildfire Interactive, $350 million was a husband-wife team. Personal investment in SlideShare was also a husband-wife team, actually husband-wife-brother team. About 25% of our portfolio is outside the US. Usually our check sizes are very small, 50 to 100K on first check and 100 to 500K on second and third check.
Paul Lee. I'm one of 3 partners at Lightbank. Lightbank is a $200 million early stage fund based out of Chicago. We're typically looking to invest in companies outside of Silicon Valley. We actually start with a fundamental thesis that great companies can be built anywhere, and within the 8 square miles of Sand Hill Road, it's very well served. Outside of that region is where we're really looking. So we think there's a misallocation of venture capital dollars relative to great entrepreneurs, and so we're spending the bulk of our time outside. On the female entrepreneur side, roughly, I think 10% of our portfolio is female founded. But anecdotally, if I look at our top CEOs. I think they definitely over-index women. So if you have any female founders out there looking to pitch ideas, I'm open after the panel.
I'm Cindy Patness. I'm founder and managing partner of a micro VC firm called Illuminate Ventures. We launched in 2009. We've really stuck to a single area of focus, which is enterprise cloud, enterprise mobile software companies. We're on our second fund at this point, and I am a founder and CEO of a venture-backed tech startup myself, so I have a long history of being involved in the venture community and as an entrepreneur, really very, very strongly endorsing and supporting women in tech, to the point where a couple of years ago we actually wrote a white paper that you'll find, I think, pretty regularly quoted on the topic. Within our portfolio, about 40% of the companies have a woman on the founding team. We absolutely never, ever use gender as an investment criterion. We simply believe it should also not be a barrier. So we've gone out of our way to put a variety of different mechanisms in place that help to ensure that. Within the portfolio, we've actually had 2 exits, both of those women founder CEO-led companies, one acquired by Hearst and one by Autodesk. So our first exits are women-led companies.
Very good, thank you. Just curious, who's in the audience here? Maybe a show of hands, who is a founder of a company or is looking to launch a company? Okay, how many investors are in the audience? Okay, well, there's our audience. There's who you're speaking to. Let's just dive into it, especially since I see that clock's running. It's let's just dive right into it. You're all early stage seed stage investors. What's been the biggest change? What trends are you seeing that's impacting you the most right now? That's actually 2 questions. Sorry. What's impacting you the most right now as early stage investors?
All of the consumer internet investors who've jumped over to my side of the equation, the enterprise side. That's probably the biggest one. And I'll tell you what's interesting about it is the challenge it can create in terms of a typical consumer internet company at an earlier stage gets a higher valuation and a higher round of financing because they need it. Enterprise software companies can typically build product, get to market, get their first beta customers on anywhere from $1 to $2 million. And so the challenge is finding entrepreneurs that are savvy enough to understand that they don't need, in their first round, $5 million at $10 million pre to build their business, because they're going to be putting it at risk when they get to the next round of financing.
So are you saying you need more capital as a consumer internet company than an enterprise company?
Interestingly enough, at the very earliest stages, I think you do.
I vehemently disagree with that, but okay.
Well, go on with that, Dave. What do you mean by that? Don't stop.
Don't stop.
I mean, enterprise companies, probably you need to have a direct sales force at some point, which are going to be more expensive. You probably might need to spend more time building the product to satisfy an enterprise customer. I don't know. At least my experience has been enterprise companies definitely need more money in the beginning. Maybe other people vary on that remark.
Yeah, but what I'm finding on seed companies trending over time is that they're raising bigger rounds earlier on.
Well, they may be able to raise
yes.
bigger rounds. I don't think they need bigger rounds.
No, I'm not. It's just what Alistair asked, what's changed, and I'm seeing bigger rounds being raised at the seed level comparatively to a year, 2 years ago, and not to say that they should or they shouldn't, but it's a trend, and probably a response to impending Series A crunch. I've also seen the number of companies being created increase quite significantly, which I think it's a fantastic thing. People should found companies and should innovate. There are a lot of problems in the world that needs to be solved. And I've also seen the supply of capital increase. More and more I'm seeing people either leave bigger funds to start their own fund, or diaspora of other companies that have some personal capital to invest as angels. And I think there's a structural shift going on in how companies are funded these days, and I'm sure we're going to talk about that as the panel progresses with syndicates on angel lists and whatnot.
Is that across all sectors? What you're finding?
I think
Well, that's like a time. I mean,
Yeah.
some sectors are hot and some aren't.
Yeah.
So you're going to find ebb and flow there. And right now, enterprises.
You said you're not at bigger rounds in the seed level, but would you say that can be across the board?
I think generally, yes. I mean, people would come for seed rounds at $500,000, $1 million, and now we're seeing on average seed rounds $1.5 million to $2.5 million.
Do you think that's a healthy trend? Raising more money early?
I think it depends on your business model, right? I think you should raise to hit your milestones, and you should be very clear of what your milestones are. You shouldn't raise because money is offered to you, right? But if you don't raise enough to prove your proof points, you're going to be left in the death valley. Or if you raise too much, you're not going to be as scrappy. So
Yeah,
it should be bottoms up.
I mean, there's kind of two elements to this. If you raise too much and don't spend it wisely, and it's easy to do when you've raised too much, to think that you should hire salespeople before you really know the product market fit, some of those kinds of things. If that happens and you find yourself not having gained the kind of revenue or customer traction you need in order to raise the next round, and you've got a pretty high valuation, it can be very difficult.
I mean, to me, it seems like, with the exception of YC companies, that'll be the asterisk here, the founders who raise a lot of money and have high valuations are because they have a track record. And so theoretically, they're more experienced, they are more scrappy about how they're deploying that capital. But I don't know if it's a disturbing trend or not. I actually think there's too much capital in Silicon Valley right now.
Yeah, I was going to say, I think that's also a Silicon Valley, New York phenomenon, that there's more capital availability. I don't know that that's true around the country, maybe slightly up, certainly around the world. I don't think that's true at all. In fact, there's still scarcity of capital, particularly at seed and Series A rounds internationally.
Totally agree. We invest throughout North America. We have investments in a couple in Pennsylvania, one in Michigan, one up in Canada, and very, very different environments there for raising capital. And I think, in part, that the bar, which is always high, and you always hear people saying that, the bar gets even higher when a company is going to have to build itself within an ecosystem that isn't quite as supportive as Silicon Valley. But that means there are some really scrappy and really strong teams out there that are making it.
I actually would disagree with that. The arbitrage opportunity actually ends up going away as the companies mature. Like, regardless of region, if the metrics are there, people look at a Silicon Valley company the same way they would look at a Chicago company if the metrics are there. It's early on, when it's like a seed investment, people don't believe it can happen. But generally, if the metrics are there, the valuations and the amount that you can raise at a Series A plus or B round are actually, those differences end up going away over time.
Yeah, and I think they probably raise from the same people, which is why those differences go away. When
Right.
you're raising incubation, seed, and even early stage A, it may be a more local phenomenon that's based on the availability of capital within the region or the metro.
How important is the availability of capital when you invest in an early stage company? And I mean, how do you make sure that company raises a follow-on round, raises a Series A, and goes on? Is that becoming a bigger factor in what you guys do?
Get customers, focus on
Yeah.
revenue.
Invest in good companies?
It's always been important. I don't think it changes. The simple fact is that in order to go after the round we're generally in that $1 to $3 million Series Seed or Series A. The next round after that, that's the $4 to $10 million round, requires the company to have demonstrated that they in fact have the right to scale, that they have put in place at least some proof points, whether that be customer adoption or other elements. It's not always customers, because deep technology may have other proof points to it, but those things need to be there as the next step.
Yeah, just the one caveat is our firm invests internationally, not as much as Dave's firm does, but that's a factor, right? And some countries might be hot at some point, and then Series A, B capital just disappears, and you should think about the timing of your investment and also macro conditions, currency and whatnot, competitive landscape, and that's a factor, particularly for investing abroad.
Yeah, I think very recent experiences. So we're pretty active investors in Brazil, India, Southeast Asia, and Mexico and China. In Brazil, there's 200 million people. It's a very vibrant economy, and there are 4 Series A funds, and they've actually been kind of sitting on their hands in the last 6-9 months. That makes it very challenging, even though we think there's tremendous opportunities in that region. We have to be very cognizant of what downstream capital is thinking and doing, or we need to be able to provide probably 250 to 500K more for the company to bridge into an A round, which hasn't been our strategy domestically. We don't need to be doing that domestically, but we do need to be doing that in other geographies.
I don't hear that too often, Dave. How active are you in Brazil?
We've done 25 investments in Brazil over the last 2 years. We've done about 35 in Mexico in the last 2 years. We're kind of still getting started in places in Asia, but Indonesia looks really interesting over the long run. India looks interesting over the long run, although it has lots of challenges. China has other complexities, but I think, again, we're trying to figure that out. We're going a little bit slower there, but the long-term opportunities in China are probably the most interesting of all those. Near-term, Mexico is fantastically overlooked, an easy place to do business, very well-educated engineering talent, similar models to the U.S., close proximity to the U.S., just really great opportunities there. There are 2 active Series A funds in Mexico, maybe 3.
For all of you, are the valuations that you're seeing overseas, are they creeping up? Are they becoming normalized to what is happening here?
Fortunately, they are not.
Unfortunately, they are not.
In Brazil, they did.
In Brazil and China, they were higher a year and a half ago. Now they're not as high.
Right. But not a lot is happening.
In terms of activity of VCs, yes.
VC
In terms
funding.
of the macro picture, I think the consumer market is growing dramatically in Brazil and other
I
places.
definitely agree.
Why are the Series A firms in Mexico, why are they sitting on their hands?
They're just very new. They've only been around for a couple of years. And there's not many U.S. funds that are active in Mexico. In fact,
Right.
really none. In
Mhm.
Brazil,
Did
there
you-
are a few.
Yeah.
You bought Mexican VC, right? That was
We
or
acquired
yeah.
we acquired an incubator
You
that we were
absorbed.
investors in down there.
Mhm.
We are actually small investors in our downstream Series A partner, Alta Ventures. I know that's a weird thing, but we're investors in them, even though they're a larger fund in that region. But we do a lot of interesting things for relationship.
Mhm. Moving on to the funding platforms, Renata mentioned those. You know, we have, I mean, it's one of the hot topics, and I've heard it mentioned here today. What is it? I'm drawing a blank. AngelList, Founders Fund, Vator has its own system. How's the syndicates affecting what you're seeing?
Could we
how you're
define
operating?
what a platform is first?
I was going to ask you to do that. I throw it back at you.
You're talking about the equity funding platform.
Yes.
Well, you know, it's fascinating to me. I have, so I think that the enterprise side of the world is impacted slightly less than the consumer side of the world in terms of crowdfunding, at least. Not so much AngelList. I think, you know, that's ubiquitous, and virtually any kind of a company might get involved there. I heard a comment earlier today from someone who's here in the room, in fact, about someone considering using crowdfunding to fund a fund of funds, which, you know, how someone, you know, putting money together as a crowdfunder really even understands the mechanics of a fund of funds is a little astounding. However, I've had some fascinating experiences where people that we've shared deal flow before have asked me to sign up on their syndicates on AngelList, meaning pay a management fee to them for introductions they might make, when, of course, we've referred things to them without any of those kind of economic exchanges. And so I think there's going to be some really interesting dynamics that take place.
I think there's going to be a bloodbath. Well, for the...
I said no, by the way. Thanks, but no.
I think if you're a small micro VC without a differentiated brand or platform, I think you're dead in the water. You just don't realize it. I mean, because that capital is very easily accessible. It's overcapitalized right now, and with the syndicates, if you have a name brand Angel, there was a deal that we just looked at where a guy committed $750,000 worth, and he syndicated out $550 of that. So, you know, I think that's going to be the trend. So if you have a $25 or $30 million micro VC fund, unless you're either a subject matter expert in a vertical or you have a brand like Dave and Felicis does, I think you're you know, it's going to be really tough going.
What about?
I would
yeah,
distinguish a
go
little
for
bit
it, Dave.
between. So I think of what a lot of people are talking about as platform is anything that doesn't look like traditional VC, which is a pretty broad and not specific definition. I think there are very narrowly defined platforms, which are technical platforms to raise money, and those are AngelList and Funders Club and things like that. Actually, also Trusted Insight, which is a platform for LPs. Full disclosure, we're investors in AngelList and Trusted Insight. And then I think, so the trend that I think is material to discuss is non-investment resources for VC firms. I think that is the significant and substantial trend which is happening at all parts of the ecosystem. So Andreessen Horowitz investing a ton of money in people who are doing recruiting and business development and marketing to some extent. First Round Capital deploying resources for a lot of things that are education and community focused. We have a distribution team. I know Science and probably certain parts of Lightbank do that as well, where they're really trying to help companies do early stage product and marketing. And there's other examples of that, Google Ventures also. And I think that's, not jury's still out on whether that's a good investment of our time and resources. I think it's clearly the case that we're able to get differentiated deal flow because we offer those services. Whether we actually have an impact on our portfolio in a positive method that offsets the cost is still to be determined. But we are betting that that's the case.
That's kind of to the point of what Mark Suster was talking about in his early talk of more firms adding value-added services. FF Capital provides accounting for their portfolio companies. What are you guys seeing in that regard? Are more entrepreneurs seeking, hey, what else can you do for me?
Interestingly enough, we were really curious about that. We're a small firm and fund, and we know we can't, provide the kind of resources that an Andreessen Horowitz or others of that size can. So we did some research. We went out and gathered feedback from 250, 300 CEOs of venture-backed startups, and we asked them, earliest stage of your business, what do you want from your investors? What is actually the most valuable to you? And the astounding percentage of the people came back, I think it was 70% or more, saying the most critical thing for us is assistance in getting the next round of funding. And the number two thing was getting customer and business partner introductions. So what and by the way, as far as I'm concerned, number two actually leads to number one. And so in our firm, one of the things we've done is build an advisory council of about 40 people, all enterprise software background people, founders, current executives in large tech companies that could be buyers of these companies' products. And we've created now a database and a network of thousands of contacts that's proprietary to our portfolio companies to help them specifically with those introductions and references.
To Dave's point, is that paying off? Are you seeing a return from that?
We've literally
effort?
done that in the last 6 months. I would say it's too early to say. It was a small enough level of effort, if you will, that even, we've seen several sales happen as a result of it, so I guess the answer would be yes. Even if only those sales ever happened, and I'm sure there'll be many more.
We've invested quite a bit in the platform. We have a recruiter, we have a marketer, we have a developer, we have head of sales that's built out call center teams. All these people on staff, and to Dave's point, I don't know what the ROI on it is. I think we know that it
You guys
helps.
have a substantial history of success doing, telesales, call center, sales-focused teams.
So we have the blueprint there, and it helps. But I think the reality is the good founders, the founders that we backed, where in hindsight we look back and say they did a phenomenal job. They would have probably gotten that done on their own. They would have found the right guy. So I think in some respects it's a necessary function that you have to compete. Right. At the end of the day, if the top firms are offering this functionality, whether the entrepreneurs, when you ask them if they want it or not, ultimately, when they do the head-to-head analysis, those things are going to factor in. And so I think it'd be silly not to invest in those things for the time being. Like, time will bear out. I think it's interesting. Benchmark, one of the most successful firms in all of venture, doesn't do any of these things. Right? They're complete opposite. And I'm sure they're not going to invest in those resources anytime soon. So time will tell.
I think you make a really good point about when you said a period of time. You know, I've been around Silicon Valley long enough as an entrepreneur originally, evaluating all of these companies that we were raising capital from, who back in the heyday, which is when, you know, pre-burst of the bubble, we were raising capital. They all had recruiting partners, marketing partners, all of those things. They all went away, and now they're coming back again. Similarly,
I think a lot
corporate
of things
venture
went
was-
away in 2000 and 2001 for many reasons.
But they went away, well, some of them went away for good reason, others for less good. But I think our industry is somewhat cyclical. I guess that's all I'm saying. Things come and go. What, you know, consumer is hot, enterprise is hot, a lot of things are cyclical.
I agree there's cycles going away, but I think the trends are more because there's specialization happening in a lot of areas, and I think, you know, the platform or non-investment resources are more a function of stage and vertical. So I think that when you choose a category of investment area, you know, whether that's early stage, you know, Series A, Series B, or later stage, there's different problems that the companies are working on. You know, earlier they're working on product development, maybe they're working on customer development. Middle stages, they're doing marketing scale and monetization. Later, they're doing organizational scaling. And I think the functions of each of the investment firms that are thoughtful is going to map into the needs that are specific to their stage. And then similarly, in vertical, you're going to see a different set of needs from e-commerce companies with physical goods than you would from SaaS businesses, than you would from mobile-focused businesses. So I think what you're really seeing is just an increasing maturation of the industry and specialization and branding for firms, and then developing, hopefully, the, you know, non-investment resources that accelerate their companies or at least drive deal flow.
And I mean, for us at our firm, the way that we can leverage the expertise to the max is really verticalizing our investments and having a pretty deep pool of companies in each of the sectors that we focus on that are hopefully best of breed and doing the most cutting edge things at some point in time. We can't profess to know everything about every single challenge, but our founders and our portfolios do, and a lot of the work that we do is matchmaking and hearing, okay, you're going through this challenge, that other company, you should talk to that founder because they've been on a similar situation to you, and those interactions are extremely helpful, on top of finding them customers and helping them scale the business also from a fundraising perspective.
We've mentioned YC in passing, but we haven't really discussed incubators or accelerators. What value are they bringing? Are you seeing a good deal flow? Do you like working with them?
Yeah, accelerators are crock. I don't think that stuff's going to work.
We have it on the record. Okay. Next question. Well, and speaking about specialization, I mean, aren't we seeing that with some of the incubators? We have Rock Health focused on digital health. Lemnos Labs has a hardware specialization. Are we going to see more of that? Do you like that trend?
I think for sure we'll see more. You know, Alchemist is doing all enterprise, and because they're doing all enterprise, they get our time and attention to come and actually mentor their portfolio companies. It's valuable to them and to us. And, you know, I get pitches probably once a week from someone wanting to start a new accelerator, just wanting input and advice.
And wanting money.
I should be talking to Dave, not me on that topic, but wanting money, exactly. And each of them is coming at it from a different angle, for sure. They're trying to.
There are clear benefits to scale, right? So if you're, let's say, a GE or a Freescale or an OEM, and you go to one incubator that is focused on hardware, right? And all of the companies are dealing with similar problems around tooling, around prototyping, and you can get really literally benefits to scale. And I think a big benefit also of incubators is you can find your first customers right next to you. People get using that's how you find your traction, your product market fit, and that concentration of people that get what you do and can give you that first push is really, really interesting.
I think there's a lot of different models for whatever you want to call it, incubator, accelerator. We tend not to differentiate too much on the terms, but certainly vertical focus within an industry is a great place to focus, and I think, you know, Imagine K-12, Rock Health, several others are doing that. I don't know what their success rates are. It's still pretty early, but that would seem to make a lot of sense. I think there's For the stuff that we have been doing, we've kind of settled on cohort size that's somewhere between 15 to 30 teams and probably somewhere between 50 to 100 people. I think there's a lot of accelerators that overthink control and guidance issues and try and focus on small sample size and them really contributing a lot of benefit. And I think for some models like beta work in science, I think that does make sense. They're really owning and operating those businesses. But aside from that concentration, I would say people tend to think too small in terms of sample size because the failure rates are very high. I also think there's virtues from having large sample size where, if you only have a cohort size of 10 and your success or survival rates are, 10 to 30%, you may not get very many wins. You might risk getting 0. If you're upping the sample size to maybe 25 or 30, then you're more likely to get 3 to 5 very good outcomes, and they'll provide a competitive environment, and I think that drags the rest of the cohort up. So most people question our model because we do so many investments, and I tend to turn that around and say one of the reasons I think we are successful is because we have large cohort sizes, we have large sample sizes, and we're more likely to find success given the high attrition rates.
Function of ownership, though, isn't it? Ultimately, at time of exit. Because if you own, I guess the question is for someone coming in, if they're part of a cohort of 30,
Yeah.
Realistically, their expectation is you're not going to be spending a ton of time with them. Their value is the brand and the community.
Their success is not usually based on a linear correlation of our time to them. It's more based on the availability of other peers in their group and creating a center of gravity where other people pay attention. And I think we get more attention by having 30 companies than we have 5 or 10 companies. And different people have different arguments around that, but it's worked for us.
Someone's passing notes in class. We're winding down here. What's hot? What's getting you guys really excited? Either companies or certain sectors that you want to see more of?
Women founders, of course.
Of course. Glad you said that. Thank you. Anything that's top of mind that is really exciting right now?
I think for us, in terms of just new disruptive technology trends, we've been paying a lot of attention to just the 3D imaging space, but more on the software side of things. We've heard a lot of printers being created, but when we
and MakerBot had a nice exit as well.
Yes, they did. And
thank you.
Thank you.
Well, I didn't contribute to that, but when we looked at the stack, we saw a lot of value on the software and imaging side of things. And if you think about Facebook, Instagram, all of those companies being built on 2D images and what the world can be if everything around us can be modeled in 3D. So that's a scenario that we're envisioning, and we're scouting ideas. We have 2 companies there, both on the capturing and on the processing side, that are getting us pretty excited. We also love the idea of software eating DNA, called bioinformatics. We have one company in the prenatal non-invasive genetic screening that can test for over 100 types. All it requires is blood or spit from husband and wife, and really a software application to genetics and bio. And lastly, it's we think we're in the middle of a hardware renaissance. More and more we're seeing new hardware being created to capture new types of data, new types of behavior, and new insights being output from that. We've been investing in the space for a while, but we think that now there will be new platforms, there will be new sensors, a new software to be built on top of all that stuff that people are going to subscribe to and get insight from. And that's an area that we're spending a lot of time. And that doesn't only stay on the consumer side, on the B2B, sort of drones, satellites, UAVs. We're having a blast looking at a bunch of interesting things there.
Anyone else?
Yeah, we're looking at a lot of things in the enterprise mobile space. So mobile itself is a huge arena still, but interestingly enough, the intersection between enterprise and mobile, and even between industrial applications and mobile, starts to get very interesting as people start having the ability with sensors and all the rest out in the field to have fat-thumbed engineers being able to use mobile devices to do all sorts of things around compliance and security and automation that simply couldn't be done in the past. So we're looking at some very interesting companies that take that technology, apply it in areas like mining and oil and gas and field worker types of activities that sound not all that sexy, but are very interesting business opportunities.
We like ugly businesses too. We actually, Dave will know. Dave's actually a co-investor in some of our companies, and we avoid anything that is a trend right now. So like wearables, we won't invest in. And part of that is just because I think, one, we're probably too late to that game as seed investors. Two, I think, frankly, we don't know anything about it. So, like, great. Google Glass, like, confounds me as someone from Chicago. Like, I can't believe people wear that around. So, a guy from California was at my brother-in-law's wedding. He wore it through the entire ceremony, and I guess he was recording something. But, the reaction in the audience was pretty, like, totally offended, basically. So... I generally think like call's dumb, but
he was doing him a favor.
like some of our like really good companies, we have a company that insources food into corporations. They're doing a $400,000 a month run rate right now. Great business, zero churn. They just signed a term sheet for an 8-figure.
Fudo, right?
Yeah.
Yeah.
So
Paul,
Dave's
you-
an investor
yeah.
in that company.
You look outside of Silicon Valley. What region has you the most excited?
Yeah. So we've been spending. This is going to sound weird. We've been spending a ton of time in Omaha, Nebraska. Found a company there doing an
That's
$8 million run rate, doing their first round of funding. The founder had taken out a second mortgage on his house. And all the founders there are like this. They're all putting their own skin in the game. This guy works, he bootstrapped the company from the very beginning, and they work tirelessly. And the notion of doing a $10 million Silicon Valley round is like, they're astounded that a company based on an idea and some early traction in San Francisco. By the way, the message I would give to founders is if you're rolling out, we invest in a ton of local startups like SMB services. San Francisco is the absolute worst market you can start in, and it amazes me that so many startups start in San Francisco, mostly because those merchant service businesses are hit up by 15 startups a week trying to sell something. So I would say we never go to San Francisco. It's the very last market that we go into for our startups. We start in Chicago, roll out to Austin, and then go to Atlanta. So there's a well-defined blueprint around that sort of stuff. But
In Nebraska. Go
And
Cornhusker.
Nebraska.
Final word, Dave. We're out of time. Final word.
I guess I would echo a lot of Paul's comments is we like ugly and unsexy businesses. And in fact, the substantial trend that I think that we're focusing on, I guess I should say, we were investors in MakerBot, but that was a complete lark. And the fact that we, got that investment was just because Bree's a really smart guy and someone told me that and we made the investment. We're focused on really basic segments, consumer businesses, SMB businesses, more and more family, kids, and parents and seniors. Seniors is a very overlooked market that's huge. The dramatic changes that we're seeing are just incredible adoption of devices across every demographic, every language, every country, and really just ubiquity of internet marketing, coming monetization and distribution, and just making those businesses that have been around in the Valley for 10, 15 years easy to do internationally. Most exciting company that I've met in the last 6 months was a 120-person company started by 3 brothers under 30. It's in Saudi Arabia. I met them in South Africa. They did $10 million a year last year. They're going to do 15 to 20 million a year this year. They're profitable, and they've never taken a dime of capital.
Are you going to tell us their name?
Sure. Nobody in this room is going to ever take a chance on doing that. So it's OTS. The website is OTSSC. They do mobile marketing and advertising solutions for the Arabic-speaking market. And I'd love it if anybody wants to join me in this deal. It's going to be probably one of the best deals that I do this year. But I doubt any of you will ever lift a finger to write a check for that company.
Okay.
So it's going to be all ours.
Hands off. Well, very good. Well, thank you very much. I appreciate everyone, standing room only, and how about a hand for the panel? Thank you. And Bambi, are you coming up next? Yes.